Let's cut across to the Voyage event. It's one of the biggest guests speaking to ET Now, Chris Wood.
Unprecedented lows in the US stock market last year. My basic view is that there's a growing risk that the S&P 500 has made a major top. And my view is so long as monetary tightening in America continues, we are going to see continuing volatility. So I think volatility bottomed last year. We have to remember right now that we have a double whammy of monetary tightening going on in America. We have the Fed raising rates, but we also have the Fed contracting its balance sheet after the huge expansion in the balance sheet caused by quantitative easing since 2008. So there's a double whammy of monetary tightening. That's also why I'm now keeping an eye on credit spreads. This is a chart of US BAA-rated corporate bond yield spreads in America.
Okay, that's just a glimpse of that conversation, but do remember, we have a whole host of top market voices that we will be getting you on the channel. This is from the Aditya Birla Voyage 2018 event that ET Now has partnered with. Chris Wood giving us a sense of what the overall global scenario is right now. Well, let's cut right back to him speaking.
When the bull market and treasury bonds began more than 35 years ago, and what this chart shows you is that the 10-year bond yield is up towards the upper end of that trend line. Most economists, most market commentators are expecting bonds to go above 3% in America based on cyclical acceleration, rising inflation. If that's true, it's a big call because it means a 35-year trend is ending. That would be negative for financial assets in America, very negative for bonds. Equities will do better, but it will be negative for equities too. My base case, I've not got a consensus view here. My view is that the bond yields will not break out of this channel, that the US economy will not prove to be as strong as people are currently anticipating, despite US tax reform. And in my view is that monetary policy tightening works with a lag, and these rate hikes will cause a slowdown in the US economy. What's the yield curve saying? The yield curve this year has begun to flatten again. And the reason the yield curve has been flattening is because the short rates have been rising more rapidly than the long end of the US yield curve, or the long end of the bond market. So the bond market is saying what I'm saying, that growth is not as strong as what the economists and the stock markets are hoping. Meanwhile, next chart is US Treasury bond futures, and a few weeks ago we had record high short positions on US Treasury bond futures, reflecting the overwhelming bearish consensus on US Treasury bonds. So as I say, my base case is I would be a buyer of the 10-year bond yield just below 3%. But that's not the consensus view. The consensus view, US economy is accelerating, inflation's coming back. Next chart relates to Federal Reserve balance sheet reduction. The more they reduce the balance sheet in the US or the Fed, the more likely that monetary tightening negatively impacts markets. But when we talk about Fed balance sheet contraction, we also need to think about G7 central bank balance sheets, because the Federal Reserve in America was not the only central bank doing quantitative easing for the last 10 years. The BOJ and the ECB have also been doing it, and the Bank of England. And last year, G7 balance sheets in aggregate still expanded by about 17%. So the risk for global markets grows significantly if G7 central bank balance sheets in aggregate are contracting, and not just the Fed. And for now, it's just the Fed. But if we stick with the current plans of the ECB, by next year, G7 central bank balance sheets in aggregate should be declining. For now, they're still rising. What has all this QE meant? This QE, all this quantitative easing in the G7 world since the financial crisis in 2008 has led to a huge pickup in narrow money supply. This is US-Japan Eurozone monetary base, and this huge pickup in narrow money supply made many people assume back in 2008-9 that quantitative easing would prove to be very inflationary because the money supply was growing. The reason all these QE policies have not so far proved inflationary is because despite the big pickup in narrow money supply, velocity of money in circulation, or the rate at which money turns over, which is nominal GDP divided by M2, has been declining ever since the QE policies were adopted. And it's because velocity kept declining, that's the reason why bond markets have remained in bull markets. So if we are going to get the long-predicted return in inflation, for that to happen, we need velocity of money in circulation to pick up. So far, we don't see the evidence of that. You can see since QE policies were adopted, velocity has continued to decline. It's a very important chart to monitor, data to monitor in coming quarters is going to be the velocity data. What about US monetary policy? For now, we should expect the Fed will keep raising rates. The new Fed chairman, Mr. Powell, is a bit of an unknown quantity, but it's important to understand he's not an academic economist. He doesn't think in terms of econometric models, unlike his predecessors, Mr. Bernanke and Mrs. Yellen. So frankly, he talks in a very straightforward language. He seems to me to have a lot of common sense, so I think he's just going to run monetary policy not based on theoretical models and just based on the data. And for now, he's trying to gradually normalize monetary policy. The key data point to watch is the wage growth. What triggered that big February correction in the S&P was the highest year-on-year wage number since 2009, it's important to understand that wage growth in America is still not that strong. It was average hourly earnings growth was 2.7% year-on-year in March. What has picked up this year is the inflation data, and that's what's driving this inflation scare. What I've done, I've got a core PCE inflation, which is the Fed's target is core PCE, and that has been rising, but it's more or less around the Fed target of 2%. It was actually it's getting closer to the Fed target of 2%. It was 1.6% year-on-year in February. The formal target's 2%. But the line going straight up in this chart is core CPCE price index 6-month annualized change. So when you annualize changes, you can make inflection points look more dramatic. However, the last month data could be the peak in the US inflation pickup because the base effect meant that March's number was going to be strong. So we're still at 1.6% on a year-on-year basis. The Fed's target's 2%. Meanwhile, a lot of people are now talking about a big inflection point where China, which for many years has been exporting deflation. The big story in the markets right now is that China's going to move from exporting deflation to exporting inflation. And this is another reason why inflation's finally coming back. What's my view on this? My view of this is partly correct, but I don't believe in the big picture story. There's one area where China has begun to export inflation, and that's in the commodity area. So the pricing power of producers of industrial commodities has definitely increased in the last year or two, and that is because of a very important policy in China being pursued by the current Chinese government, which is known as supply-side reform. The key point about this supply-side reform is that the Chinese have started to address excess capacity issues in their commodity space, And the two key sectors where the excess capacity issues were greatest and where there's been the greatest action to reduce the excess capacity have been coal and steel. And that has meant that for anybody globally, including companies in India involved in coal or steel, that has been a big positive. And I believe this supply side reform will continue in China. So I believe the capacity will remain under control. So that's good news if you're involved in coal or steel. And the chart, this chart on the screen shows an increase in import prices in the industrial metal space, but there has been no commensurate increase in pricing power in terms of manufactured goods. So while there's evidence of China exporting inflation in the commodity space, I don't believe that story holds true in terms of manufactured goods generally. What about the health of the US economy? The US economy is definitely going to accelerate significantly this year because of US tax cuts, particularly corporate tax cuts. But from a consumption standpoint, it's important to understand that in the last several quarters, consumption growth in America, as shown in this chart, has been running ahead of income growth, which means the savings rate has been declining, and that's not a healthy sign for sustained growth. As a result, you can see savings rate as a percentage of disposable income has fallen significantly. So personally, I don't believe the consumption trend is that solidly based because it's based on a declining savings rate. We don't see any great evidence of a material pickup in income growth in America. What about capex? Well, last year we did see a pickup in one area of the US in capex. That was in the shale energy area, which is a line going up strongly. This year, we will see a bit of a pickup in capex outside shale energy, primarily because the US tax reform is incentivizing corporates to front-end load capex because they can write off 100% of capex now the year they spend the money. But I think the other thing that's going to happen because of US tax reform, which is encouraging corporates to repatriate money from offshore. The other thing that's likely to happen as a result of US tax reform is a renewed surge in share buybacks. And this is what we're currently seeing in the data, share buybacks picking up strongly. Share buybacks are good for shareholders and the companies doing the share buybacks because it boosts ROE, but share buybacks aren't going to do anything to cause a pickup in the US economy. So the bottom line is the US economy is okay, but the cyclical acceleration hopes are not going to be as strong as people are currently hoping. And because the US equity market was very overvalued when the tax reform happened, while the tax reform will create a pickup in US corporate profits,